Hit it.
It's Friday, September 17th, 2021, episode 149. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show Dario Perkins from TS Lombard. We have a great discussion about the macro environment and find out why Dario is not the ECB's favorite guy. Then in Talking Charts with Patrick, the sorcerer is back to regale us with his magic mark.
All right. This week in trading history, we go back to the failure of Jay Cook and Company, and we end with the segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We've got a great show. Lena, hop on. What beer are we drinking this week?
So this week, we are drinking a Portuguese beer, Superbock.
That's right.
Well, we got to own up. Some of us are, because some of us are not in Canada.
Oh, but you can get this at LCBO now. I looked it up. Well, you can get
so
it at
I did
LCBO.
not do it. I did not do it. So I am drinking my good buddy Andy, who sponsors the show, my good friend. When he gave us the Barn Raiser Country Ale, he gave us way more than we deserve and rightfully should have, and I'm still picking away. So thank you, Andy. I'm going to be drinking this, but Patrick is in Lisbon. He living the life of a playboy.
I have not made it back yet. It's summer vacation's over. I forgot to get onto a plane, but
we wouldn't let him back.
We had to track him down.
But Lena was here drinking Superbock with me earlier in August. And
I didn't realize that.
Time.
I wasn't invited.
No, you. Whatever. You were like on your little road trip. Like you weren't even checking your emails. You had the invite. You just made it into your junket folder or something.
Okay, so anyway. Tell us about this beer, Lena.
So, authentic and magnetic Superbock has a regular presence in your life. Its positive and close energy makes it the beer of excellence for your socializing moments. I would read the description of the actual beer, but it's very, very long.
Oh, okay.
That's like such a cheesy description. That's all, but it's actually
a really
pretty
good beer.
Smooth tasting beer.
What's it like? Is it like a Peroni?
Yeah, you know, like
I think so.
Yeah, exactly. And it's when I was down in Barbados, it was like drinking the Banks, right? It's that summer beer that they have. That's that 5%.
It's like nice and crisp.
It's good.
You have to bring me back some, Patrick. If we ever let you back.
Sounds like a deal.
Okay, let me do our disclaimers. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the spreaded eagles, the front month flu, and unwanted liquidations.
That's so relevant today. Anyway, that's funny. All right, let's get to the interview.
It's our great pleasure to welcome to the show Dario Perkins, who is the Managing Director of Global Macro at TS Lombard. Dario, thanks for being on.
No worries. Good to talk to you.
It's great to chat with you. We like to get to know our guests a little bit. And before we started the interview, you actually admitted a sad truth that you've always wanted to be an economist your whole life.
Well, I mean, you have to keep that in a bit in perspective. I mean, initially I wanted to be. I remember watching Top Gun at a cinema in kind of 86, 87, and obviously wanted to be a fighter pilot. So,
okay. When that didn't work out, you decided you're going to be an economist.
Yeah, I mean, my eyesight's not too good. I think that's a problem if you want to buy an F-14. We don't have F-14s either in the UK, which is a bit of a problem.
That's right. So why don't you tell us a little bit about that? You mentioned earlier that there was a faithful trip to the Bank of England that piqued your interest. And walk us a little bit through your kind of upbringing and how you've come into this role as a macro strategist now.
Yes, so I started studying economics when I was 16, I guess. We have GCSEs in England, and it's kind of introductory stuff. And we went on this field trip to the Bank of England, and for some reason, I found this very exciting. Looking at, I think it was the gold actually in the vault of the Bank of England, and then we went across to the stock exchange, and I saw all these traders shouting at each other in these funny color coats, and that quite appealed as well. So. And then I kind of got into, A-level economics, which is the next level of economics. Then I just stayed with it. And then late 90s, I found myself at the UK Treasury,
okay.
which is an economist is a good place to start out because There's lots of smart people around, but for some reason they give you this enormous amount of responsibility quite early on. So if you go to the Bank of England or somewhere like that, the chances are you'll be forecasting the price of handbags for your first 2 years in the job. Whereas at the Treasury, they just sent you off on all of these kind of big kind of meetings and things where you felt completely out of your depth. But
wow.
I've still got the agenda from this OECD meeting that I went to in Paris when I was about 22. And you look through the agenda and it says representing the US is Ben Bernanke, representing Japan is Mr. Kuroda, and then representing the UK, Mr. Perkins. I mean, it's ridiculous. It's ridiculous. And my first job was doing Gordon Brown's forecast for the world economy. So I got to hang around with all these cool people, and I remember sitting in the back of this silver Mercedes with Charlie Bean, who was the Bank of England's chief economist, and Mervyn King. And that was 2003 during the deflation scare. And they were having this very elaborate conversation across me because I was in the middle of the seat, and they were on each side talking about how we couldn't get deflation in the UK because their policies were so credible that the Phillips curve had completely flattened.
and there you were as a young punk just listening to this,
thinking, how cool is this?
Right.
And so that was really my first kind of role. And then after a while, I think you get a bit frustrated at somewhere like a government department because, well, firstly, the pay is awful, and all of your friends from school have gone off to other jobs in finance or wherever, and they're suddenly earning 3-4 times what you're earning.
Right.
But also, there's a lot of massaging egos that goes on in a place like that. You have to copy in everybody and everything you do, and I wasn't never very good at doing that. And I was always kind of fascinated in financial markets, going back to those traders shouting at each other on the London Stock Exchange. And someone like the Treasury was really bad for that kind of thing, particularly before the global financial crisis. There was no coverage of markets at all. And there's always this story about, and this was just a few years earlier, but when the UK was part of the exchange rate mechanisms, had a fixed exchange rate against Germany and those other countries. And as sterling fell out of that mechanism and as the currency plunged, the Treasury had no way of seeing what the value of sterling was in real time. They didn't have a Bloomberg terminal or Reuters or any of that stuff. They were all crowding around this radio listening to BBC commentary of where sterling.
Come on. Seriously?
It's a true story. So you've got the Chancellor of the Exchequer and the Prime Minister sitting drinking tea, listening to the radio, trying to figure out if there's
trying to get their sterling quote.
Exactly. So there's no real exposure to markets, and then so I started to have interviews in finance, and I remember going along to this interview, and I think it was this Australian head of rates trading at ABN AMRO, and I decided I'd name drop because just 2 weeks before I'd been on this one-on-one meeting with Ben Bernanke. So I thought, I'd say that I know Ben. So I started name dropping Ben Bernanke. And this guy said to me, you know what? Next time you see Ben Bernanke, you can tell him that I think he's an effing tosser.
Very Australian.
This was after so he'd just done that speech, that big speech, making sure it doesn't happen here.
Right.
In deflation. And this guy had obviously lost a huge amount of money because yields had completely plunged after that speech. And there was all this stuff about, deflation was coming to the US and what was the Fed going to do about it and all this stuff. And, that kind of really, really opened my eyes to this different type of environment, because that was so different to where I'd spent the previous 5-6 years. You couldn't imagine calling policymakers that. So, so I kind of fell into investment banking, and for about 5 years that went pretty well. And
so, what were you doing? You moved from the Treasury to a bank, and which bank was it? And what was your role there?
Yeah, so I moved to ABN AMRO, and I was doing European economics.
Okay,
and we had this. It was quite a global team. It was quite a small team. But it was very highly rated in all of the II and Excel surveys and all of that stuff. And it was just because we didn't take it particularly seriously. We used to write this daily note where we really just took the piss out of each other and then threw a bit of economics in as well. And it turns out that investors love that kind of stuff. So, one of my colleagues used to tease me that I had a gold BMW, and this became famous. I'd get clients coming over and they'd go, you're that guy with the gold BMW, aren't you? That was what I was known for. And, and it was just we used to have a laugh and we were doing macro as well, but we were trying to make it quite friendly and easy to digest. And, sometimes it got me into trouble. So, the best example of this is that I wrote this note directed to the ECB, and it was called 10 Things I Hate About You.
Okay.
Movie, that movie.
That's right. I remember. Yeah.
So that was about the same time. So it was just a list of things that I thought the ECB did really badly.
Okay.
And 8 of those things were kind of genuine criticism. And it was things like, they're completely obsessed with the money supply and they're not very transparent and we don't know how their voting works. But when I got to about number 8 on this list, I was seriously running out of things I could say. And so I think number 9 was something like the ECB's website is completely unusable and I've given up with it. And number 10 is that I suggested that Jean-Claude Trichet should change his sartorial choices, that he was dressing in too much grey and it was clashing with his hair. I mean, this was just a joke, and I point out this was a joke in the note. And I sent this note out, and then the next day I got this call from the press office at the ECB. And it was this woman. She was this German woman. She was very, very angry. I can't. And, she started off pretending that this was about, the criticism about the ECB website. So she said, so what's wrong with the ECB website? And then she said, but, really, the whole tone of this note is completely wrong. And you can't write notes like that. And, I said I was joking. People know that this note is a bit of a joke. We take the mickey out of each other. And she said, no, you can't do that. It's completely unacceptable. So the next day, I made this even worse because I wrote another daily note. And I said, from now on, I'm only saying nice things about the ECB. And it's not because the press officer from the ECB called me yesterday and told me. Then she called me again. And this time she was livid. And then this went away and it was quiet. And I thought, that's fine. I'm not going to get into any trouble for this. And then the ABN AMRO chairman went to Davos. And one of Trichet's people got hold of him, showed him this note and said, this is completely unacceptable. What is this guy doing? And, my boss called me into his office. And that was the one time I was totally convinced I was going to get fired.
Oh, because you said it clashed with his hair.
Yeah. And actually, people say that you can't influence policymakers when you put these notes out. But from then on, he was wearing very different suits. He was wearing these kind of very contrasting ties. He really changed his game after that.
So there you go. So, when people say that you can't influence policy, monetary policy or fiscal policy, you have proof that you can actually do it. You changed his wardrobe.
Yeah, and so there you go. So you can change things. They're not maybe the things that matter, but he still raised interest rates several times when he shouldn't have done. Debt crisis, during credit crisis.
No big surprise that guy's a tool. Okay, so you're there. It's in the early 2000s. We get the great financial crisis, and obviously,
I'm sitting there at the epicenter of it. And
right.
ABN then merged with RBS in one of the most spectacular, ill-advised mergers in history. ABN had all this, dodgy, toxic American debt on its balance sheet. It blew itself up. I remember every day at 4 p.m. we'd get called up to see the chairman talking about everything was fine and the bank was stable and yes, there were a few liquidity problems, but it was all going to be great. And then, a few weeks later, the bank is nationalized. And suddenly I'm working for the government again.
Right. Which you've already shown you're not actually probably suited to government work.
And I'm still having discussions with equity strategists at ABN AMRO because they're saying, surely this isn't going to affect our bonuses. Surely we'll still get paid. And I'm like, come on, we've just been nationalized here.
Yeah.
And so, after that, I took some time out and then I went into independent research. And, I've been working at TS Lombard doing global macro ever since then.
Oh, well, that's great. That is one of the funnier stories, Dario, that I must say. I loved it. So let's get to your views on the market. And I'm going to start with, I saw an interview you gave, I guess it's probably 3 to 5 months ago, and one of the things that you said that really struck a chord with me was long super cycles based on power dynamics between labor and capital. And you talked about who is winning determines what our institutions do. Could you elaborate on what you mean there and how it works in terms of these longer term cycles?
Yeah, so we've had these kind of 30 to 40 year cycles. So, after the Second World War, we had this kind of mixed economy where, the labor and capital were basically working together, and you had powerful trade unions, you had powerful companies too, and you had powerful governments. And then, the kind of end of that was the great inflation, when you had this structural slowdown in productivity. Powerful trade unions refused to accept real wage cuts. You then had these powerful wage price spirals through the 70s. And then we had neoliberalism, Reaganomics, Thatcherism in the UK. And that inflationary backdrop was absolutely critical to that, because then we just reshaped these power institutions. We destroyed trade unions, we globalized, we financialized. We tried to ensure that kind of inflation could never come back, and obviously crushing worker power was a big part of that, and that's really been the dominant theme for the past 40 years. And I think we've got to the point where that's now in question, where I think, if I'd said in the late 90s that maybe trade unions weren't bad, they would have kicked me out. Whereas now you've got people like Biden in the US suggesting that, well, maybe this old super cycle went too far. Maybe this destruction of worker power went too far. Maybe we need trade unions. And you've got, big question marks about the corporate sector as well, about whether it's become too powerful, whether it's really as competitive as it was supposed to be. And so it's the beginning of this. I think. I think people are looking at this, and particularly an older generation, and they're thinking, well, we're just going to go back to the 70s. We're recreating that post-World War II environment. And something like MMT, I mean, it's very similar to the post-World War II regime in terms of thinking. A lot of the stuff that they suggest is kind of recreating that environment. And people look at that and they say, well, that's where we're headed back. And so you've got all this stuff about we're going back to the 1970s. And it doesn't help, of course, that suddenly you've got all of this inflation in the data. And a lot of that is supply bottlenecks. But even in labor markets, there are these little pockets of worker power because, people haven't gone back to work as quickly after the pandemic. Maybe they're still scared of getting sick. Maybe they can't get the health care. Maybe we've been paying high unemployment insurance, and that's discouraged people. So you have these pockets of worker power. But I don't think those two things are related. I don't think the numbers that we're seeing in terms of inflation are related to the fact that this super cycle is on the turn. I think this inflation story is very, very transitory, and it will wash out quite quickly. But, something is changing in the world. We are looking at a I think I called it a kind of gentle inflection point in this super cycle. And, there could be setbacks along the way. We already see, governments are starting to get a bit worried about their fiscal positions again. In the US, also in Europe, there's big question marks about midterms in the US. There's question marks about the German elections. There's question marks in the UK. We could have policy missteps, and we could sometimes go backwards a bit. Right. I don't see how we can possibly live in the world that we've lived in for the last 10 years, that world of austerity and this terrible mix between fiscal and monetary policy. And, when we had long-term interest rates at 800-year lows, I have this data that goes back 800 years looking at lots of different countries. That's kind of screaming to you that something is wrong in the world, that the policies are wrong. And so, I'm kind of optimistic about that. I think that people are worrying about the end game here, and they're thinking, well, where is MMT going to take us, and where is all these deficits going to take us, and that stuff could be years, if not decades, away. And actually, if politicians start to believe in MMT, I think that can only be a good thing, because we need fiscal space. There are these big challenges that we're facing over the next decade, climate change, infrastructure crumbling, inequality. And those things can't be solved with monetary policy. We can blame central banks for creating inequality and all that stuff, and lots of people like to do that. But it's not really about monetary policy. Monetary policy is not the solution to that. And some kind of acceptance of MMT opens up that fiscal space to deal with those kinds of problems. So I think this is unambiguously good.
So let's just take a step back, and you've spoken about the change in attitude amongst economists. Why don't you give us a little history of how that has evolved throughout the past, let's just say, 2 decades?
So after the 70s, after the inflation of the 70s, we fully embraced monetary policy again. It kind of echoes of the 20s. So 1920s, all about monetary policy. We have the Great Depression. We discover that monetary policy can't solve that, and we move into fiscal policy. And the US stagnates for a decade until the Second World War, when we get massive fiscal spending and we break out of that kind of secular stagnation. And in the end, that fiscal policy creates inflation, and then we do everything we can to crush inflation. And it turns out that monetary policy is very effective for dealing with an inflation problem. It's not so good at getting inflation higher, but it's good at getting inflation down again. And that was the lesson from Volcker. So then we move into this kind of bizarro world where fiscal policy is completely discredited. We have all these rules about what fiscal policy can and should do. And central banks take over, and we live in this world of monetary dominance. And obviously that leads to credit bubbles, and we have the global financial crisis. But we come out of that crisis, and we still believe that monetary policy has all the answers. And so, after 2010, governments everywhere start to panic. People like Bill Gross put out his bed of nitroglycerin comment about UK gilts. And governments worry about turning into Greece. And we have a decade of austerity.
Can I interrupt there, because you have some great stories of being actually at? I guess you weren't at the. Were you at the Treasury at this point when Bill Gross made his comment?
I did a kind of brief cameo back at the Treasury after the global financial crisis.
Oh, okay. You went back to help them out through it. Okay.
They had 2 projects that they wanted me to do. One was looking at the Bank of England's remit and seeing if it was still fit for purpose. Given my experience working in, or slagging off central banks, I guess. given my experience there, they wanted me to do this kind of what's the word? An evaluation of what the bank had been doing. At that time, the Treasury really didn't trust the Bank of England. They'd kind of fallen out over the global financial crisis. And then they had this idea about macroprudential policy. So as I said, they had no real background in finance. They didn't really understand the links between the financial sector and the real economy. The global financial crisis had come as a complete shock, and they wanted to know what the lessons were. So this was the birth of macroprudential policy. So I was doing 2 specific projects working on that. But obviously, the austerity thing was a big question. And, it was that time Bill Gross puts out his note, UK gilts are sitting on a bed of nitroglycerin. The UK yield is at 4.5% at that point, we should point out, before eventually going to 0. But at that point, it was 4.5%. And he put out this note. And the Treasury, the government, totally panicked about this. I mean, I remember being called into these meetings, and they said, this is a massive problem. If this becomes a theme in markets, we're totally screwed. What are we going to do? And so, you have this push to austerity. But, one of my jobs at that time, they got me to put together this kind of 40-page PowerPoint presentation that the government could send kind of junior ministers all around the world to try and convince foreign investors not to dump their UK assets. So it was 40 pages of why the UK is actually quite good and you shouldn't dump US securities. But it's a sense of how much they were panicking. And we had these regular meetings with the ratings agencies. So back in the early 2000s, you'd send, the kind of summer student to meet these rating agencies, and it would be kind of very junior Treasury officials. By 2010, you've got the Chancellor sitting in these meetings,
right?
And they're kind of ordering posh sandwiches for them to try and convince them not to downgrade the UK.
Right. Can I just actually jump in here and ask you a question? Eventually, Dario, you've become, let's just put it this way, sympathetic to MMT and have seen the benefits of let's just say how they understand how the real economy works and the real financial markets work. Although you do have your complaints and your criticisms that we'll touch upon going forward. At this time, did you understand MMT and realize that this was not going to be a problem, or were you caught up in this same worry that, let's face it, all of us were? There was the Rogoff and Reinhardt book, and this was the prevailing attitude amongst everyone, was that you had to, debt got us into this problem. You had to cut debt. Where did your kind of evolution stand at this point?
So I think I was in that kind of traditional mainstream view, where if the bond market lost confidence, you're in trouble. The bond vigilantes still ruled. And, that was very much the view at the time. I mean, you had the Reinhardt-Rogoff stuff, as you said. They'd published this big study saying that when debt hit 100% of GDP, you were basically in big trouble. You had the sovereign debt crisis in Europe. I'm not sure that people really understood the difference between a country like Greece and a country like the UK. Certainly Bill Gross didn't. You had the Bill Gross comments. You had this, this was taking over, and also that I think there was a presumption that the world would go back to normal quite quickly after the global financial crisis. You remember that data, 2010, 2011 was all quite strong. That the economy seemed to be bouncing back, and in the UK we had an inflation rate that hit 5%. And it stayed 5% for 2.5 years. I think there's big parallels that we can come to later with what's happening in the US with this burst of inflation you have in the US. But we had this kind of transitory inflation problem, and so somewhere like the Treasury, where it's traditionally has the Treasury view. I mean, that's what it comes down to. This idea that you have to keep bond markets happy, and certainly that was the whole focus of what the government was doing back at that time, and it was the focus everywhere.
Right.
That was the narrative.
And Dario, when did you start to, fast forward a decade, you've started to realize, or you've realized that that's not how it works? And when did the light bulb start clicking to you that all of the economics that you learned in university and stuff wasn't quite what we thought it was?
I'm not sure that I see it quite like that. I think it's that, the mainstream complaint about MMT is that MMT is nothing new, which is bizarre when you think where we were a decade ago. But if you drill down a little bit, what they're really saying is, if we're in a zero interest rate world, if that equilibrium interest rate is zero, then pretty much everything that MMT says is correct.
Okay.
That, to me, that's a really important distinction between mainstream and MMT thinking. And so MMT says that interest rate will always be at zero because the government can just hold it at zero. And mainstream economics is saying, well, eventually we might need to raise interest rates. And then things like the equivalence between debt financing and monetary financing, that kind of stuff starts to break down a little bit. But I think if you'd known back in 2010 that we were going to be stuck with perma zero interest rates, I think that would have led you to very different policy conclusions. But I do think that it was only really over the course of the 2010s when deficits remained quite big and debt was accumulating, and there were just so many examples of it was becoming clearer and clearer that the debt didn't matter to bond markets. In fact, yields were just going down and down and down, and so I think that by the time it got to 2016, 2017, the world looked very different. You had negative interest rates across parts of Europe. You had, as I said, bond yields at 800-year lows. By that time, it was becoming clear that there was something quite different about the world. And I think that over that 10-year period, MMT had basically just got everything right, whereas the mainstream had got everything wrong. You started with the impact of austerity after the global financial crisis. MMT was saying, this is wrong, don't do it. I had a lot of sympathy for that once I got out of the Treasury, actually. So there was that focus on austerity being wrong, and then you had the Eurozone crisis, and for me, one of the really important moments was after Draghi had said whatever it takes. And then something very fundamentally changed in the nature of that crisis. And it came down to that difference between currency issuers and currency users, that distinction that MMT always makes. If you're a currency issuer, you can't run out of money. You can't be a victim of the bond vigilantes. If you're using somebody else's currency, then you can. And that became very clear during that Euro crisis. And I remember, meeting after meeting with investors, the question was always, where is the balance sheet going to come from to stand behind countries like Italy? That was the question from all these investors time after time. And in the end, the ECB didn't have to do very much. All it had to do was say that it was going to provide that balance sheet, that it was that lender of last resort. And then the whole basis of the Euro crisis changed. Suddenly markets had no interest in trying to force yields up. For a while, you'd had this one-way bet. So you bet against Italy, yields go up. Italy then has to use more austerity. The politics becomes more difficult. It becomes more likely that Italy's going to get forced out or choose to drop out of the euro. And so then yields rise again. So you have this perceived one-way bet in markets. And then the ECB comes in, and by turning countries like Italy from being currency users into currency issuers, it totally transformed the nature of the euro crisis. So to me personally, that was a really important point. And I think, that has been, and then, through the 2010s, you've had a series of, examples where governments have suddenly spent huge amounts of money, and it's not had any of those kinds of repercussions that people worried about in 2010. You had the period where Trump was cutting taxes aggressively. You had governments in Europe that stopped doing austerity, and yields continued to go down. There was no worry about it. And then COVID comes along, and suddenly governments are spending, they're spending like it's the Second World War again. I mean, you look at government deficits, the biggest blowout in government deficits that we've ever had, and yields go down. And so, you have this period where MMT is just right time and time again, and the mainstream is wrong time and time again. And then the mainstream says, well, we knew all of that. We just didn't know that the environment was going to be what it was. It's kind of bizarre. And I was laughing the other day on Twitter because there was somebody who put this very recent Richmond Fed study of MMT. And it started with, the big problem with MMT is that it's only been right for 35 years. What? That's your criticism? That's your starting?
That's right.
So, I think the world has changed. And I think that, it's always difficult with this stuff because different politicians will try to use deficits for different purposes. So, the right wing wants to cut taxes for the wealthy and the left wing wants to spend. So the politics is tricky, and in the US, I think it's a very tricky situation because you have the whole Trump, we didn't really lose the election thing, which dilutes the discussion a bit because you're not really having a discussion about economics. You're having a discussion about what is the truth, what really happened.
Right.
But I think things will change. I think that if it turns out that these massive stimulants that we've had from Biden, if it turns out that Bidenomics, doesn't create sustained inflation, if it turns out that the bond vigilantes don't come back, then I don't see how something like that won't spread to other parts of the world. And I think, even in Europe, I think there's a softening of things like the rules that they've been using. I think governments realize that when they have these very strict limits on debt and deficits, they discourage governments from spending in the exact areas where they're going to have to spend. Infrastructure spending has been absolutely hammered over the last decade. Green investment has been hammered. Those are the things that you cut when you've got a deficit target because
those are the only
people don't complain as much. And so I think they've realized that those kinds of rules are going to have to change. But the German election is a really pivotal moment for Europe.
We'll get to that. One of the things that I just like to throw out there is you have this, you talk about Thatcher, and I always kind of laugh at these old guys that tell me, oh no, we have to cut, and if we cut into fiscal spending, everything will be great, and they'll use Thatcher for example, and you have a great explanation about why Thatcher's cuts worked and why it won't work today. Maybe you could kind of just recount that to us.
So this was the Treasury again, 2010. Somebody writes this paper looking at austerity during the Thatcher years and pointing out that it led to this massive boom. And obviously, we've got a new, fairly right-wing government at that time, a conservative government obsessed with Margaret Thatcher. George Osborne, who was the Chancellor, is desperate to be just like Thatcher, like every conservative minister ever. So this analysis becomes really important. And I remember, very senior officials at the Treasury saying, "Oh, this is such a great paper. This is exactly what we need. It shows what we need." But when you really think about it, what happened? I mean, they took interest rates from 15% to, very low kind of single digits. And they created a massive boom. We had a massive housing boom and a massive credit boom. Those were not things that we could reproduce. It wasn't just that it was austerity. It was austerity combined with massive deregulation of financial markets. And that led to this huge boom in credit. And, the bit that was missing in all that analysis that the Treasury did, and it seems bizarre because it was after the global financial crisis, but it was private credit.
Right.
And, we just couldn't do that over the last decade. There was no appetite for private credit. And so, we like the US, we had household deleveraging. And so you had the public sector deleveraging and the household sector deleveraging at the same time. And that was just a recipe for disinflation.
Right. And so one of the things that, I've heard you complain about with the MMT, and I have a similar complaint, is that there's too much focus on the government side of the equation, about the fiscal side. And it's almost, to me, I don't know if you feel the same way, but they assume that that's going to be the only lever, and they almost don't realize that, yes, although private sector credit creation has been neutered recently because of the high levels of debt, that still is a tool and a lever in the economy. And you mentioned earlier how you thought that MMT just wants to take away that tool and to not use monetary policy. And you have a solution that's much kind of more of a blend and something I'm much more sympathetic to. Do you mind sharing that with us? So,
I joke with clients that I want to live in a world where politicians believe in MMT and central bankers don't. And what I mean by that is that you want governments to pursue fiscal policies that they think are good in themselves, not because that they're, it's not about worrying about the deficit or the debt consequences of it. It's about, if you have an investment project and you think it's going to bring some kind of social benefit, then you should do it. And we probably want to be in a situation where governments are trying to do too much after a decade where they've done too little. But you want to be able to respond to inflation because, the big lesson of the 70s is that you couldn't trust governments to cut spending when it was just about inflation because they always thought, well, we'll accept a bit more inflation for a bit less unemployment. And, that was the whole basis of why we had independent central banks. And so for me, MMT, it kind of goes too far. It wants to go back to the immediate post-World War II period and ignore what happened in the 70s and 80s and ignore the fact that, there are some situations where monetary policy is actually quite useful. And so that kind of extreme version of MMT, where you basically switch off monetary policy, you just set interest rates at zero forever and you focus entirely on fiscal policy. And when you've got an inflation problem, you can trust the politicians to tighten because that's fine. Fiscal policy is much more effective. I just think that ignores the lesson of history. History shows you that there are times when monetary policy is very effective, i.e., if inflation is a problem. And there are times when fiscal policy is very effective, if deflation or secular stagnation is your problem. And so what you want is a framework that, empowers fiscal policy when you need it, but allows you to use monetary policy when you need that too. And I don't think that MMT is quite that. But I think as a kind of stepping stone. I think we almost by accident we've come out of this crisis with a much better policy mix than we could have hoped, because MMT is starting to influence the fiscal debate, and so it is opening up fiscal capacity. But we still have independent central banks, and these central banks still worry about inflation. And I don't think we're going to live in that kind of world of financial repression where the central banks just ignore inflation. I know that that's a kind of popular narrative with the inflationistas, but we've kind of stumbled into this. I think we end up with a much better way of running policy going into the 2020s.
Oh, that's fascinating. So you say that you do not believe that we're going to have permanent financial repression. So let's just think this through, or walk this through this.
Well, I don't think we have the inflation to get there. To me, we have an inflation problem right now, which is about bottlenecks, supply issues. Basically, COVID caused global demand and supply to collapse, and initially demand fell faster than supply, so you had this deflation scare. Now demand has recovered faster than supply. You have all these supply bottlenecks. We have some inflationary consequences associated with that, but I think you really need to find a new secular driver. And I joke with clients that we had a recession that wasn't really a recession, and we've had a recovery that wasn't really a recovery. But we also had an entire cycle during the 2010s that didn't really cycle. We just had these mini cycles that was reflecting what China was doing, and we were in this kind of world of secular stagnation. And China was the only country in the world that was providing balance sheet. China was having this kind of romance with MMT, but it was a very on-off romance. So there were times when the government would massively increase its balance sheet, but then it would panic about the debt consequences of that and suddenly tighten too much. And this was creating these kind of mini cycles in the global economy. The credit impulse against global PMI, that chart that everyone was using, and just confused so many clients. They'd send me this chart all the time. How does this make sense? How does this reflect the trade links between China and the rest of the world? And I think it was that we were in this world where there just wasn't a balance sheet expansion. DM governments were too tight. Central banks couldn't get the private sector to borrow. And so you had these mini cycles reflecting what was happening in China. And I think that China doesn't want to play that role anymore. That China's romance with MMT is basically over. I think that's one of the reasons that markets have been a little bit skittish recently, because every time China's credit starts to contract, you get all of these scare stories about Lehman's moments coming out of China. But I don't think China wants to play that role anymore. I think it's worried about turning into Japan. It's going to run its economy cooler than it has. We talk about a world where the rest of the developed countries want to run their economies hot, but I think China wants to run its economy cooler. And so, you've lost China added about 30 percentage points to global debt over the past 10 years. So, what's going to replace that balance sheet? And so I think you're either going to need some kind of new secular growth driver that comes out of the developed economies. So maybe housing, maybe something to do with a sweet spot in demographics, maybe new hybrid work patterns, bring in a new marginal buyer for housing, because you can now live further away from your office. So you can, younger people can afford to buy housing. That could be a secular driver. Maybe there's a productivity revival, because we've all learned how to use this technology a little bit better than before. And, this slowdown in technological diffusion was one of the big issues of the 2010s. But if the private sector doesn't kick in and replace Chinese balance sheet, then it's going to have to be DM governments. And I just don't think that's going to create sustained inflation quickly. And I think those people worrying about financial repression are just seeing this world where the bottlenecks that we have now turn into this kind of sustained inflation problem similar to the late 60s. And then central banks refuse to raise interest rates. So we get this kind of financial repression regime. I just don't think central banks are going to need to repress financial markets in that way, because I don't think they're going to have the kind of secular growth stories that will deliver that. But I think it's an interesting end game. And that's why I think that, if we did go full MMT, maybe that's where we would end up in 10, 20 years' time. And at that point, you wouldn't want to have your monetary policy turned off, which is why I think this new regime is actually much better than what MMT is suggesting.
One of the things when you tell the story and you go through it and explain how China is no longer taking that baton and running with it in terms of leading the world in growth, we've had the initial response to COVID, which was a big fiscal push in developed markets. If we get a situation now where as things return back to normal, governments once again get a little scared about deficits and debts and think go back that they have to balance the books. Could we see a situation where growth actually disappoints to the downside, and we almost need a market event to cause the governments to have the will to actually create more deficits again?
I think that's what worries me at the moment. I think that there's been too much narrative about the regime has changed, and now governments are just going to spend, and we're going to end up with sustained inflation very quickly. I worry more about us making policy missteps, and we're coming out of this crisis. We have massive debt and massive deficits, and for some politicians still this is clearly an issue. And I do worry that we might think that we can return to normal faster than we actually can. Just this week I've been kind of sketching out this kind of downside scenario for the world. So, you go back 6 months, everyone's talking about a roaring 20s, the YOLO economy. You only live once. And, that narrative's taken a bit of a battering over the past few months. And I think part of it is just this realization that, COVID hasn't actually gone away yet. And it's not that I think we're going to be stuck with, continued COVID disruption forever. I think there are questions about the efficacy of vaccines, for example. So, there's some data that shows that it starts to fade after 4 or 5 months, which is a bit of a worry. And you see that in Israel. But there's UK studies as well that show the same thing. So we have all this stuff about boosters, and I think there's a risk that some of this disruption continues for longer than people are expecting. I mean, the consensus has been so wrong about this since the start. I mean, it was supposed to be a 6-week problem, and then it was supposed to be over last summer, and then it was supposed to be one more wave, and then the vaccines were a silver bullet that it would immediately allow everything to go back to normal. That whole story's taken a bit of a battering. And I think that, we have to think about, well, what happens if this disruption continues? And it's not that we sink back into where we were last year. We're not going to get another massive decline in GDP. We can see that each wave of this crisis is having a smaller effect. But it takes out some of that right-hand tail to growth. It kills that roaring 20s narrative. It kills that YOLO economy narrative. And I think it also means that the disruption that we're seeing in inflation, that could continue for a while. And so, we see the Delta variant is causing more supply disruption, that we've got, the freighting costs are starting to go up again, semiconductors maybe not coming back as quickly. And again, I don't think that causes a sustained inflation outbreak, but I think that it gives us a world where everything just looks messy for a bit. The inflation numbers are messy. The GDP numbers are messy. Inflation becomes more volatile. I've been calling this the VILE regime, which is volatile inflation, limited expansion. And it's not that that's the world that we're headed into, but I think that could be the story for the next 6-12 months if we can't just break out of this as quickly as everyone is hoping. And it just becomes quite messy. And then you start to get, policy questions. Even if you're an MMT enthusiast, if you're seeing inflationary pressures, do you start to think, well, maybe we've overdone it a bit? That's been the Larry Summers argument. And so, it's been kind of encouraging, I think, that the whole US debate about fiscal policy has actually been about inflation. So, Larry Summers, for example, thinks that Biden has done too much, and he thinks the consequence of that is inflation. That's very different from saying that the bond vigilante is going to come back and blow up the public finances.
Right.
That's a story about judgment and about how the economy is going to perform and what a given amount of stimulus is going to do in terms of inflation. That's a much healthier discussion than the one that we've had before. But I think we may not get some clarity on some of these questions for a while if this, this kind of tricky environment that we've been in. And I think, for me, investors have been they keep saying to me, where are we in the cycle? Where are we in the cycle? And I think it's because they're trying to apply traditional investment rules about where you are in the cycle to what you should buy. What's going to happen to yields, which sectors of the stock market do you want to be invested in? And, this isn't a cycle. We haven't been in a cycle. We've been in this kind of weird world where governments shut down their economies and then try to reopen them again. We kind of reset the global economy. And it's just caused a hell of a lot of noise. And it has caused market volatility. But the market volatility has been in rates and it's been in equity sectors. So if you look at the standard deviation of the performance in different equity sectors, it's unprecedentedly large. So there has been volatility, but it's been this kind of story. Well, we're recovering. We're not recovering. Yields are going up. No, yields are going down. By value, by growth. It's been these very mini moves in markets as people have tried to understand where we are in the cycle. But this isn't a cycle.
Right. One of the things that we, a strategist struggle with is differentiating timeframes. And you've laid out why we might have over the short run or medium run a growth kind of disappointment, governments that don't spend enough, and maybe we've gotten too excited about the potential for growth. But you do have a view about longer term, what this kind of regime shift means and how you should set up your portfolios. And I'd love to hear that. And I'd also love to hear you have a theory about what's going to happen or potentially could happen in Europe with the green bonds and them issuing, in essence, green bonds out of thin air, meaning you don't need to borrow from it and you just spend without worrying about the deficits, and how maybe that might be the trigger for this next wave of growth higher.
Yeah, so you have this regime that we're in at the moment, this kind of stop-start, reopening, not reopening, COVID's accelerating, COVID's slowing. And that's given you these mini cycles in value versus growth and in rates. I think if you're looking at the kind of longer term super cycle, so we come out of this crisis, we have central banks that maybe are prepared to take more risk with inflation. The Volcker regime is gone. Central banks actually want inflation to overshoot for a bit. And you have governments that will embrace a more activist fiscal policy. Once they realize that the inflation they're getting is not sustained, I think governments come back in and will take a much more active role. So you effectively have fiscal and monetary policy, which wants to run the economy hotter. And I think that type of environment is very different from the one that we had in the 2010s. And if you think about, what defined the 2010s, where you had this kind of perma-zero interest rate, and you had the massive outperformance of growth over value. And, you can look at this data back to the 1940s. Sometimes you can get that data back 300 years, and you never see that kind of trend. You never see that kind of consistent outperformance of growth over value. So, if we're in a world where governments are going to run their economies hotter, interest rates are going to start to trend higher, you have a kind of inflection point in yields, I think that secular stagnation world of just growth continuously destroying value, I think that ends. And I think you have a world where you can start to think about value again, and something like stock picking starts to become fashionable again, rather than just buying big tech companies on the basis that you're discounting their earnings at zero forever. And so I think it gives you a different type of market regime. Here we're talking about a 5-10 year period. We're not talking about the next 6 months because, as I said, COVID is still here and it's still causing disruption.
But one of the problems with that is that we need to get governments to spend. And I'd love to hear your theory about what might happen in Europe in terms of their ability to spend. Because let's face it, Europe has been the disappointment of the past couple of decades in terms of their just unwillingness to open those purse strings and spend, and their constant belief that we could fix everything with easier and easier monetary policy, which we see doesn't work. And you have a unique way of or a unique solution to their problem.
Yeah, if you're talking about the euro area, the problem is that you have politicians from different countries that don't trust each other. It's basically about moral hazard. The the Germans believe that if you let the Italians spend, they'll just spend and spend and spend. And eventually German taxpayers will have to fund the difference. I think, what the ECB has done that is very clever. I'm a massive QE skeptic. In the US, I really don't think QE does anything. It changes the distribution of asset returns because investors believe in QE. But I think in terms of what it actually achieves, it doesn't achieve very much. In Europe, though, it's very different because when the ECB does QE, it effectively turns a country like Italy into a currency issuer. And so, as long as you can keep those bond vigilantes away, the Italian government should be able to spend whatever it wants. And so the only limit really is in terms of the deficit limit, which is just Germans saying to Italians, you must not spend more than 3% of your GDP in a given year. And I think everyone in Europe has realized that those old fiscal rules caused big problems. And as I said before, the big problem is that it encouraged these governments to cut the things that you want them to invest in over the next 10 years.
Do you think they actually realize that? Like you speak to them obviously, and you
changed. I think there has been a change here, and I think they had this Stability and Growth Pact. They've put that on hold during COVID. They're going to reassess those rules. I think what they're going to have to do is exclude some types of government investment from those rules. And it opens it up to a bit of manipulation. So, maybe the Italians start calling all types of things green investments or infrastructure spending. And, we had this similar regime actually at the Treasury in the late 90s. It was called the Golden Rule, which was that you could only borrow to invest. And actually, I remember being in these bizarre meetings with Gordon Brown and his advisor, Ed Balls. And the rule was assessed on the basis of this chart. So you had this chart of whether the rule was applying or not. And I remember sitting there and they were having this discussion, we're not quite meeting this rule. What can we do? And so Gordon Brown said to Ed Balls, well, why don't we just make the line on the chart a bit thicker? And then it will go through. This is a serious conversation. They had this discussion. They said, well, why don't we make the line a bit thicker? And then it will look like we're meeting the rule in the chart, because the chart is the only place that we're going to show this rule. And then Ed Balls replied, yeah, but we did that last time. And I couldn't believe it. But, it does open you up to this kind of manipulation. And so I think they're going to have to be quite careful about what they include and what they don't include. But I really think that, even the Germans realize now that there's this existential threat to the world, and it's going to require governments to do more. And so, I think this idea of, it was the Second World War that changed fiscal policy after the Great Depression. This kind of idea of a war on climate change, I think that really means something. And I also think that in the US, the idea of building back better really means something too, because what it's saying is we not only need to get back to where we were before this crisis, which is what all these job furloughs and sending out checks and all that stuff has been about, but actually it's a rejection of that world that we were in before this crisis, that secular stagnation. And we need to do more. And I think the idea of, big, green, smart investments, I think that has to catch on. And I just can't see an alternative to that. So I think all of these governments are going to have to accept that they need to play a bigger role. And, that's the good thing about MMT is you can believe in MMT or not believe in MMT. But I really want the politicians to believe in it, because, that's if they continue to think that debt and deficits matter, then, we're screwed, basically, aren't we?
Yeah. Oh, no, I couldn't agree with you more. And I've always said that there's, when you get those famous deflationists that come on and they tell you how, they were burdening the future generation. And I always say, if we believe these things, then we are going to create the deflation that they are worried about.
Yeah, exactly.
Right? It becomes a self-fulfilling prophecy.
It's massively dangerous. And I think that, what's happening in the world with climate change, with inequality, these things are just screaming to be fixed. And yes, politicians have different ideas about how you fix that. So, Trump wanted to fix it by having a trade war and cutting taxes for the wealthy. And Democrats want to do it in an entirely different way. But the really important thing is that we have to have the fiscal capacity to deal with that. And if we still believed, what Bill Gross was peddling 10 years ago, you'd really be quite disturbed about where we're going, I think.
Okay, so Dario, I didn't tell you, but I'd like to finish with a few questions. So I'm going to throw them on, surprise you with them, and hopefully you can think on your feet and come up with something good. First of all, if you were to go and visit the Dario that's about to go and, work at the Treasury, what advice would you give him?
The first time around or the second?
The first time around. You're 22 years old, coming out of school, about to go do. What are the life lessons that you've learned that you would give them?
I think learn economic history. When I came out of university, it was all about maths. And I spent a lot of my first year at the Treasury working on these kind of very advanced econometric models of how the world worked. And I remember a guy that had been at the Treasury for 20 years working on these models. And he basically, said to me, you realize this is all nonsense and this isn't how the world works. And if you really want to learn something, learn about history. And I think he said learn about French philosophy as well, which I never quite got around to. But I think that's a big thing for economists and for investors. It's about not just whether something looks nice because it's written down in algebra. It's about what happened in the past. Often we've been in similar situations. And so I think history is really important.
That's a great piece of advice. Okay, favorite investment book?
Well, mine are kind of very light-hearted investment books. So, City Boy was a big one.
I don't know City Boy. What is that one?
It was written by an analyst, a utilities analyst in the 2000s, and it was about being a sell-side analyst at an investment bank, and it was just hilarious. It was him, having these kind of going into work at 6 a.m. with a hangover and pretending it was because he had food poisoning, and it really captured the kind of early 2000s in investment banking. And the other one I always remember is a book called Wall Street Me, which again, and the line I remember from that is that, remember, you're in the entertainment industry. That sell-side research is about entertainment, not just about being right. And that always struck a chord with me. So those are the ones that stuck around. There's another book about the dot-com mania. I think it was written by a Wall Street Journal journalist. And it was all about how people can get caught up in the bubble. And, he basically got very heavily invested in .com and really believed that the world was changing, and then it spectacularly blew up. I think that's a fantastic book in terms of the psychology of a bubble.
Well, that's terrific. Okay, Dario, it's been a real pleasure having you on. Why don't you tell people where they can learn more about yourself and your writing and your firm?
So I work for TS Lombard. You can find them on the web. We publish, regular kind of. It's very thematic research, so it's not about monitoring data. It's not going to tell you what the latest PMI has done or what the latest retail sales has done. It's very thematic. You can follow me on Twitter, Dario Perkins, all one word. I tweet quite a lot. Most of it is light-hearted, but there's a few charts and things on there, and it gives a hint of what we're thinking as a firm and what I'm thinking individually.
It's been a real pleasure getting to know you, Dario. I'm not going to forget the gold BMW, and also the fact that Trichet, you managed to change his wardrobe. That was a story for the history books.
See, people, worry about having an effect on the world, and I feel like in my own special way, I had that.
You've made the world a better place when you changed Trichet's dress. Anyways, thank you so much for being on our show.
Pleasure. Take care.
Take care. All right, Patrick. It's been 6 weeks, maybe 7 weeks since we've had a talking.
I've got. It's my goodness, has there been a lot of stuff that's happened, right? Like let's jump right into it. Now we got to get back into our routine. We're gonna start afresh with top 3 things to watch next week, and then we'll start reviewing them the week after. But so let's start with talking about uranium.
Yeah.
Wow.
Lots of questions. I'm going to let you do your technical voodoo magic, and then I'll jump.
Well, what is there technically to say? It went parabolic. That's all I have to say. Like,
That-
it's unbelievable how it was dead money for 6 months, and then suddenly it just everyone decided they're going to run it, and it just it moved. I mean, it's a double in a commodity in a span of a couple weeks. At least using the Sprott Uranium Trust as the benchmark. Now we've started a bit of a correction here. Some of the individual stocks like Cameco and others are starting a little bit of profit taking. But what a blast off to the upside! What's your take on all of it?
Well, I would argue that it was dead money, but that you actually could have timed it in terms of realizing what the catalyst was that eventually caused this move. And what happened was after Sprott took over the Uranium Central, what used to be called UPC, I guess, Uranium Participation Corp., they were quite vocal in saying that if they got a chance, they would issue more shares and buy uranium. So at that point, you realized that there was a vehicle upon which speculators could take out the excess supply. Because let's think about this. What's happened before this vehicle was available, we had this situation where, yes, there was all sorts of excess supply and it was trading below the cost of production. Companies were shutting down mines and we had this excess supply. And you knew that couldn't, go on indefinitely. You knew that eventually it would be that would clean up and we would head up and we would enter into a period where it was once again profitable for mines to mine the actual uranium. However, the problem was that there was no speculative vehicle to clean up that supply, meaning that there wasn't a way for most other non-uranium players to buy that, to bridge that kind of difference between demand and supply. So what happened was, once Sprott came in and said, we're going to issue shares and we're going to buy the uranium, it became clear that there was going to be a vehicle for them to do that. And I remember Cuppy reached out to me while I was on my vacation. He said, this thing's trading at a premium. And I realized at that point that if it was trading at a premium, they were going to continue issuing shares and they were going to buy the excess supply. And that's what really caused it. And so I would argue that was the catalyst. Now, the real question is, from here, there's all sorts of uranium bulls out there. It's obviously garnered the attention of the Reddit crowd or the Wall Street Bets crowd. I see that there's yellow laser eyes out there, which scares the shit out of me. But the real question that you have to ask yourself is Cuppy correct about how long it will take the uranium companies to take their mines that are currently closed and on care and maintenance to turn them back on? Because there's no doubt that there's lots of uranium out there, right? That was kind of nobody is doubting that. The question is, how quickly does it come on, and does the demand overwhelm it? And I'm going to temper Cuppy's enthusiasm. I don't think it takes them as long as Cuppy thinks. Now, he might know more than me. He's definitely more plugged in on the story. But a little part of me is concerned that the easiest part of the trade, meaning the point from which Spot was trading significantly below the cost of production, up closer to the cost of production, that easy part of the trade is behind us. And I'm not saying that we can't chug higher, but what we have to watch for going forward here is, as we chug higher, do they turn on the mines? And if they turn on the mines, how long does it take? And those are obviously questions for a lot of smarter people. I just think that you should be watching for that because I'm a little worried. I'm also worried about how enthusiastic everyone has gotten. It's a little bit, feels frothy to me, feels scarier. It feels like the easiest part of the trade is behind us.
Well, Kev, I mean, you chickening out of a trade once everyone starts jumping on to the trade is a very typical action of you. For me, technically, what I'm looking for is actually how quickly buy on dip traders come to defend the dip that happened today, right? So, like, we had a correction, and every rally is always checked. That's the most natural occurrence. And so when you get that, what typically, if it remains in bull market and if there's another full leg higher, it shouldn't take more than a week for us to see the buyers already scooping it up on dip and driving prices again. And so I actually, while it's been an amazing run and it's certainly got ahead of itself, we're now seeing that kind of backfilling secondary retracement that is very typical. But actually, I'm looking to see whether the buy on dip traders hold key lines in the coming week to see whether or not there's another full leg higher on it. Anyway, that's definitely one thing to watch. Like, it's certainly a very short-term top, but it may not be the intermediate top, and there might be more upside still, and that's something that we're going to be watching, right? So number two, like we haven't talked to markets for 6 weeks, so how can we not just talk about the broader stock market here for a moment, Kev? Because it's really interesting. Obviously, there's no shortage of people online talking about the fact that we are overdue for a correction. I've certainly been one of those people that have been vocal about that for a month or two. Just that simply every rally is always checked, and inevitably these kind of 10% corrections in the market come. But the thing is it going to be this easy, Kev? Like, September, October has housed a disproportionate amount of corrections. Is it that simple that you just go and sell in September and the market just crashes and you look like a rock star? Like, I think that the market is going to make this a little more confusing. And I think there'll be a fake out or two along the way. One way or another, what's interesting is that there's a trend line that's been violated. A lot of these traders are watching these trend lines, whichever bottoms you want to connect. The bottom line is today we had a legit breakdown. And one of the other things, using just like a 50-day moving average, which has been where almost every single correction has stopped in the last 6 months and been buy on dip every single time, we're now closing right below that 50-day moving average. Now, that in itself is not a sell signal, but what it is interesting is that, to me, this is a real important moment, because will we see that same pattern persist where the buy on dip traders emerge right at the same kind of buy point, and we're, let's say, rallying to 4,600 next week? Or do we have a liquidity event that would almost be cliche at this stage if it started happening here? I don't know. What do you have any insights? What's your thinking?
Well, I don't know why it has to be we bounce or we get a quote-unquote liquidity event. Can't we just have a regular kind of 5% or 10 to 20% correction?
I listen.
Do you consider that a liquidity event?
Well, sure. Well, yes, because okay. What was Volmageddon? Volmageddon was what, 13% correction or whatever it was.
But was it?
And it happened in a thing. I honestly think that the velocity to the downside will be really hard when it corrects. I don't think it's going to be a bear market. I don't think it's going to be some devastating 50% wipe out of the stock market. But I do think it's going to happen fast, and it's going to be painful.
And that has, you're absolutely right that is the new trend, right? Whether it be uranium going up or the stock going down, things happen faster and faster. Mm-hmm. So I'm not going to deny that. I guess what really the question is it more than 20%, Patrick? And I would say
I don't.
No.
I'm a seller. Well, you know what though? I think that stop and we want to kind of think about how bear markets emerge anyway. First of all, I'm not predicting a bear market, and neither are you. So let's make sure our listeners are clear on this. But even if you go back to the past bear markets, they always start with a 20% drop, and then that 20% drop doesn't recover. And it rolls over, and then there's multiple new waves of selling that prolong this kind of 6 month or 1 year bear market. And so I think that a 20% down is the easy call. The question is it a major buy on dip if we get down there? And will it just roar the market higher, or is it going to be the start of something more ominous? I think that we don't even have to try and make that call now. Bottom line is the market is quite vulnerable at this stage. It's at a very critical moment, and it's not going to take more than a week or two for us to find out whether the buy and dip traders here hold the line.
Patrick, you're like a guru, Patrick. It's like the journey of 1,000 miles starts with one step. the bear market of a generation starts with a 20% correction. That's Patrick Ceresna. I'm paraphrasing.
It does. But it does. And you know what? The thing is that, but if it's bought on dip properly, then it's just a correction and the bull market resumes, right? And so what I think we're just trying to determine, and 20% we're sticking on that. It could only be a 10%. I think, could we have a 400 S&P point wipeout down to 4,000? Absolutely. Does it have to be a hit down to 3,600 and a 20% wipeout? It could, but it doesn't have to be that deep. I think, we're due for one of these. Every year or so, we always get these 10% pullbacks that are just the market cleansing all the people that are over leveraged. And I think that's the base case that we have to sort of watch if this 50-day does not spur the buyers.
I'm with you, Patrick, which means it won't happen.
All right. And Kev?
Oh, I see it.
Number one.
I see it. You finally got your number one. We let you have it because it actually might be true here.
Thank you. Is this a new breakout in the U.S. dollar?
It is the most important thing.
That's the most important thing to watch.
We let them have it.
All right. So, let's take a look at this dollar index, right? I mean, we had a bit of almost a 2-week market correction in the dollar index down toward 92. But to me, one of the most important things was to determine whether or not this was a kind of the end of this short-term bull run on the dollar, was whether it rolled over here around the 93 handle. And that equates on the euro, because the euro USD was a pretty critical level, was a lot of these lows around this 118, 117 and a half, where a lot of people would see inverted head and shoulders patterns and other things that would resemble a bottoming formation. But just the way in the last 2 days that the euro broke to the downside is a red flag. It's a red flag that the euro is weak, and there's weakness on a lot of the other cross currencies, and in a weird way, it fits the narrative. If the stock market is going to go risk off, one of the most common characteristics is the dollar safe haven trade. Maybe this is all working in unison. Is that you think it can play out that way this time around?
I think it can be that simple, Patrick. I usually I'm the first one to shit all over your U.S. dollar going up call, and I'm not getting in the way right now. I don't see any point in trying to fade this. It certainly looks like a lot of things are setting up that we might, over the short to medium run, have a higher U.S. dollar.
There you go. Let's hit up some of these commodities charts. Let's just do a tour of the markets here. How's that?
Sounds good.
Let's start with crude oil. Double top retest, triple, quadruple, whatever. How many of our tops you want to count on here?
First of all, that looks like you're trying to say it's a triple top, and we all know that that's only something found in fairy tales.
It's only absolutely. You're. I'll give you that.
There's no such thing as a triple top.
With that said, as a market approaches overhead resistance, let's just call it overhead resistance in the circumstance, okay? So as a market approaches its previous highs and overhead resistance, it is typical for it to bump its head. And there you have the advance, at least stall out, as some traders are keen to take some profits along highs. But I think next week is going to be critical. Like if oil is legitimately going to make a punch to $80+ on the upside, it's going to hold above 70, and it's going to be a nice solid consolidation, and we should see a 52-week high breakout. Maybe 1 week is too short of a time frame, but in the next 2 weeks we should see that really emerge. If the oil bull market is underway. But one thing that I kind of in the back of my mind, if we did have this little risk-off event, do you think crude oil can just march to the beat of its own drum and just not give a shit?
I think it can, but chances are you're correct. It will, pause and maybe chop around here and get all the triple top people who believe in fairy tales, get them all excited. But then the moment that stops, it'll then go higher, I think. Although having said that, Patrick, you know me, I hate it when people agree with me. And I saw Morgan Stanley calling for $100 oil, and I thought, oh shit. It used to be everyone laughed when I said the $100, and it doesn't look like I'm going to get to $100 in this year. So my call will technically be wrong. but it does make send shivers up my spine when I hear those kind of things.
Well, listen, right now oil's price action is positive. It hasn't done anything negative, and so at least technically, I can't align with the bears. Other than only thing you can observe is that it's approaching a key resistance level, and so that's the way we'd have to kind of size it up. But do you think that was a top in nat gas?
Oh.
Look at the way. Look at the way that I'm sorry for bringing up your trade, or did you take your profits?
No, I'm still long, which is actually shocking for me, right? Like, because
I'm shocked because you normally when things start getting parabolic like this, you usually are the first one out of the gate.
Yeah, the only thing I will say is that I own this strip, and as every month comes off, I have to I haven't rolled it as diligently as I should be. So every month,
you are rolling some off.
I am rolling some off, but. The trouble is that I look at it and I go, yes, the front month's gone crazy, but then I go out 2 years and I look at it and go, oh my God, it's dirt cheap still. And it just makes me want to buy more. So I don't, I haven't touched it, Patrick. It's actually been, it's very unusual for me.
Yeah, well, you know what? I think that this could Eiffel Tower, buddy.
You think so? Oh, I like it.
Yeah.
I like hearing that kind of shit. I like hearing that kind of good that trash talk.
No,
okay.
I'm gonna take the other side. I think that this is now an accelerated thing. Like, listen, you know what? Maybe over the longer term, there's lots of potential for nat gas to be much higher. But I feel that this has got a very kind of lumbery feel to it, buddy.
Well, I love your skepticism.
Yeah.
Bring it on.
Yeah.
I feel like the emperor. Let the hate flow through you.
Oh, where was their hate? Where was their hate?
Well, no, but I did. You know what? I did laugh because I was. I said something that I would never put yellow laser eyes on my avatar for my Twitter. And I can't remember. I can't remember who said it. One of our shrewd, very witty market huddle listeners said he's saving it for nat gas. So I don't even know what color nat gas. So it'll be clear. So I'm going to have the clear nat gas. It's just going to smell bad. Anyways, I haven't touched it.
Your Twitter handle is just going to smell bad.
That's right.
All right.
I can't see it. I actually already have the nat gas laser eyes. You just can't see it. It just smells bad. Okay, so the next one, copper.
Copper, yeah. Like what? This is when we had this breakout candle back over here on copper. I always say one day does not make a new trend, but it was a legitimate attempt by the bulls to break out copper to the upside. And the one thing I always look for is not the breakout candle itself, but the way the price action behaves in the days that follow. And this is just not good. They didn't stick the rally. The bulls didn't show up. They didn't follow through on it. It was basically sold right into. And that doesn't make me bearish on copper. It just simply means that this is not the start of a new bull run, and that there's probably going to be some more backfilling and some more consolidation and more waiting before something more bullish happens on this front. Do you have a different view?
Well, I don't have a different view, but I will say this to push back on you, like the fact that you're not excited about copper. The most metals are getting absolutely, just like taken to the woodshed, right? Like,
look at the way that iron ore futures here
exactly
are just,
so to me, I look at copper and
murdered.
go, yeah, it's not the greatest, but having said that, it's hanging in there pretty good or pretty well. Sorry, that was bad English. But if you have a situation where it can go sideways in a bear market for metals, then I'm like, oh, that's so be it. I can live with that. So to me, copper is actually performing relatively well. And once we get on the other side of this, whatever it is, like the China-induced slowdown with too many people leaning on the inflation trade, and we clean this out, then I think you want to own copper again. I think that it's just, you're right. It's nothing to get excited about. It's nothing to go rush out and buy. But it's on the whole, to me, it's actually hanging in there pretty well.
So let's look at gold. But you know what? The one thing about this, Kev, like I didn't run the overlay or do any of the correlation stuff, but it really feels like gold's chart feels very much like the euro. It really looks like it's just trading as a cross to the US dollar in some weird way.
Well, it's also moving really closely with nominal rates.
Yeah.
So there's no doubt about that. There's lots of things going on, but Patrick,
there's one thing that isn't going on, and that's a bull market in gold.
Oh, for sure, it's been awful, and silver's even worse. It felt to me yesterday. So we're taping this Friday, and Thursday was the big ugly day down in silver and in gold. It felt to me like it was actually a liquidation event, like a sell what you can, not what you should. And I wonder if we're going to look back at this and see that it had something to do with the liquidation in China of some Evergrande holdings. I don't know if I said that. Evergrande, I don't know what to say. But it really does seem like maybe it's one of those situations where somebody is like, I need to get out of this. I need to, to make some liquidity. And I think that that's actually occurring in more than just gold, but I think gold is almost just leading the way. I think that the other markets are handling it better, and gold just didn't handle it as well because the fundamentals aren't as good or whatever.
I don't know. Like, look at this chart, Kev. Is this some major downtrend and some big barf to the downside? No way. Like, gold's just boring. It's like, look, yeah, fine. A $50 down day seems like a lot, but when you really put it in context, gold has just been boring.
Yeah, I won't disagree with you.
Like when you say something like someone's just liquidating and something, you're making it sound like it's like Alibaba over the last 6 months, right? Like,
no, Patrick, I think that's a great point, because if you step back and look at the chart, it's not like this was like a 10% move in gold. This was just somebody selling. But the question was, it seemed to come out of nowhere with no real reason for it. And what I'm saying is that I think that
the dollar's rallying.
You're right. There's lots of things. The bond market's behaving kind of badly. Looks like rate hikes have been brought forward. If you look at the front end of the curves, a lot of the front end of the curves are actually selling off, meaning those things are pricing in higher rates. 5 years are almost at the top of their range. There's lots of reasons. You're absolutely correct, and that in the grand scheme of things, it's really not that big a deal. It's still within, it hasn't even hit the lows from the summer from the spring.
Yeah.
Anyways, so
let's do a couple more quick things. The 10-year Treasury yield, it's been incredibly trade range bound, but it looks like it's edging higher. Obviously, oil is going to start putting some pressure on inflation expectations and things like that could be starting to pressure the 10-year yield. But it really hasn't been a big breakout in any way. Do you think that this moves, or is this going to be just a dull market?
No, I think it starts to move, and I think it starts to move on the downside, up in yield. I think it's going to surprise people. It's gonna behave badly, even with stocks.
Do you think that there'll be any safe haven in the 10-year yield during a correction?
No, I think that it's you should own like a good asset like Bitcoin or something like that.
Oh Jesus. Oh my God, we're going to have to end this episode right here. This is
just kidding. No, I do not believe that it's going to be a safe haven. I think it's stupidly priced. There's inflation there's more inflation than everyone thinks.
Okay. All right. I have enough talking charts for today. Well, you know what? Next week, maybe we'll circle back to some indices and some stocks and stuff like that. But I think with this bigger macro outlook is a pretty good place to start for today.
Okay. So, Patrick, are you going to let me do my rant?
Oh, yes.
You completely forgot.
Oh, my God.
So I got a rant, and I don't know. Obviously, maybe I just are overly sensitive to this, but have you seen this shit show? This Gong Show. Gong Show is better. Yeah. Of a Federal Reserve. Have you seen what these guys were doing? Kaplan, Rosengren,
unloading.
They're sitting there tossing around big trades as they're being the Fed presidents. Like, how stupid are these guys? Like, honestly, they are I'm going to say it. They are the biggest bunch of dumb fucks I've ever seen. And they should be fired on the spot. And yes, you can say what you want, that maybe it was legal, but you know that the optics are terrible and that you have set back the whole organization. And can
you imagine for one moment that the market does have a liquidity event, a little mini crash. like they are going to be raked over the coals. Like
listen, they can't win now. Whatever happens, like I see Powell had actually taken his funds and gotten somebody else to manage them, and then now everyone's going over those managements saying they owned munis and they were buying munis. Like I don't care that Powell had taken his funds and sent them to somewhere else, and that person had chosen to buy munis. That's completely fine. That's appropriate. Powell behaved like a grown-up. Okay, I'm not expecting them to go to 100% cash. I'm expecting them to do proper things and to not become day traders like Wall Street 17-year-old kids during a pandemic when people are losing their lives and the Federal Reserve is actually making decisions that are affecting these things. The lack of judgments from these yahoos is just mind-boggling, Patrick. I just can't. Like, if I was Powell, I would fire those two jackasses on the spot, and I would actually be pissed at myself for not figuring out ahead of time that this was going on. I am just astounded and just I can't even speak, Patrick, how pissed off I am about this.
We're gonna get George Gammon to send you a End the Fed hat. How's that?
Well, I don't think that. And this is the problem. This is the problem. When idiots like them make decisions like this, it gives power to people like George Gammon that want to end the Fed. The Fed, it delegitimizes all the good that they do. Now, you might be a right wing guy that thinks the Fed should be ended and stuff, and at which point, that's fine. You have your view, I have my view. But that really, really pisses me off because this has really set everything back tremendously. And if those two had any honor whatsoever, they would just fall on their sword. They would just, they would quit. And yeah. I am just as you can tell, I am livid at them. I think that it's just so bad. Like, did you see how many times they traded? And they were trading like muni bond ETFs. Like, what the fuck? And then like they're tossing around, $1 million of SPOOs at a clip. He's literally day trading. Like, anyways, okay, that's it. Rant over.
All right, let's go on.
Okay, Patrick, it's up to you to lighten this thing up a little bit. You got This Week in Trading History. What do you have planned for us?
I don't know about lightening up, but it's we're gonna go way back, September 18th of 1873. It was the failure of J. Cook and Company, which was a U.S. bank that operated from 1861 to 1873. It was headquartered in Philadelphia, Pennsylvania, with branches in New York City and Washington, D.C. Importantly, the bank helped underwrite the Union Civil War effort. It was the first wire brokerage house, pioneering the use of telegraph messages to confirm security transactions with clients. So they were like pioneering all sorts of really cool things. So J. Cook and Co. set off the panic of 1873, which we talked about before. But when they declared bankruptcy, and the boom in railroad construction in the South, coupled with a successful westward expansion projects such as the Union Pacific Railroad, had caused investors and speculators to be heavily invested into these transportation projects. Once Cook realized his firm was overextended, and the rail investments were unable to meet the debt obligations, they had to declare bankruptcy. But this is the key, and this is interesting because I often wonder what would happen in today's world, because I don't think it would play out the same way. But back then, fearing more defaults, banks all over the country began calling in loans, causing more firms and investors to default, cutting off the rail industry's cash flow, and causing more banks to, like a feedback loop, causing more banks to call more loans and so on, creating a major financial depression. The financial crisis that kicked off there in September 1873 would become one of the worst the U.S. has experienced up until the Great Depression. Much of the nation's economy did not recover for over 6 years. There was like 4,000 banks that failed, 115 railroads would go under and bankrupt during that period, and over 18,000 businesses would be shut down before the economy improved. What is interesting, though, is the panic would see Philadelphia's dominance in the finance world be passed over to Wall Street in New York. And the panic also would ruin many prominent bankers of the day, helping to clear the way for, guess who, J.P. Morgan to rise to power. And so it all started with the bankruptcy of J. Cook and Co.
You know, I always wonder why Philadelphia sports fans are so bitter, and they have a kind of a reputation as being a especially surly bunch. And I bet you it all has to do with this. They wanted to be Wall Street, and they blew it. And now you can blame Jay.
Blew it.
You can blame Jay Cook and Co. Okay.
All right.
Patrick, time for skin in the game. And when we were trying to remember what had happened last, neither one of us remembered, but we're pretty sure that you won. I had been on a little bit of a losing streak.
And so it's an easier assumption to make, that I won.
Although we probably could have looked it up, but we're far too lazy for that. So why don't we just kind of why don't I tell people about it, and then you'll have a bet for us. So Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows. A Duke and Duke, which is a crisp $1 American bill. A pint of beer, then it goes up to a burger bet, then a pitcher, then a case of beer, affectionately known as a 2-4 here in Canada, a bottle or a box of wine in Patrick's case with a $100 limit, and finally the granddaddy of them all, the steak dinners.
Yeah.
Okay.
The
winner of the bet is obligated to create a new bet for the following week, and all wagers settle in full, and there will be no netting of positions.
So I'm making the bet. Here we go, buddy.
You got to make the bet.
I am going to go after your not laser eyes, but smelly Twitter account.
Smelly eyes. Smelly eyes.
Smelly eyes. With Nat Gas.
Oh.
And over under $5. Come on, straight up.
Okay, so which contract are we talking?
This is the continuous, but if you want, we can.
No, we got to pick one because I got to know the role and stuff. So you got this. Not because there's one every month, and they move. Let's do. We're gonna just go November. All right.
Okay. November's trading 509. So I'll give you over under 5.
Oh, I'm gonna take over.
Okay.
All right.
All right.
Over on the 5, and now the question is, what do we bet? So I'll go straight to a pitcher.
Done. You know what? For this piss up that we still have to figure out.
Yeah.
By the way, everyone that's waiting for the news, we just need some clarity on our end. We will be making announcements as we go, but no news for all of you today.
Our trouble is that we want clarity on our end, but we're worried that Canada's going to shut down again. We don't want to kind of schedule the piss up, have people book flights, and then have us closing the borders. And so we're just going to see what happens in the next couple of weeks. We will see if there's any signs.
We will announce.
We might have a new government. At which point, if we have a new government and the conservatives get in, we'll be like, what the hell? Everything's open. Let's go. We're definitely having the piss up.
All right. So we're a pitcher beer. That's going to be for the piss up. Nat Gas over under on the November contract at $5. I gave you an extra 9 cents just because I'm being kind.
You are. I saw that you were. But I would have gone if you hadn't given me that much, it would have been a harder decision, and then you wouldn't have gotten me to be long. Plus 9 cents on the front month, it moves that in no time. It's probably already down below that now. Okay, time for No Stupid Questions, where we get the real star of the show on here with us.
Lena.
Hello, Lena.
How you doing?
Hello. It's weird to be back like this now.
Yes, it is strange. Patrick was telling us how much he missed us. You wouldn't really expect him to be so
I forgot that I was a part of the huddle after 6 weeks.
I was a little uncomfortable when he started crying, but otherwise I was good.
All right, we'll move on to the first question here. Hi, guys. Great show, really enjoyable listen. Historically, I've generally had a long-term buy and hold strategy for my portfolio. More recently, I've been looking at introducing a stop loss and sell orders, particularly at key support levels. Having backtested this method, it would certainly have led to an improved portfolio performance. My question, which is somewhat simplistic, do you guys believe stop and limit sell orders are a good idea? And if so, how do you usually set these without simply getting shaken out by market makers? Thanks and keep up the great work.
Patrick, I'll let you go first. This is up your bailiwick.
Well, okay, so first of all, we have to differentiate investors from traders, right? And investors that use diversification as their tool often can build portfolios and not have to overthink these things. But when you're a trader, and I don't mean a day trader, I'm talking about someone who is tactically making active decisions in their investment portfolios, especially if you choose to use any form of leverage or you choose to concentrate yourself in ideas. Risk management becomes very important beyond diversification. And one of the most common things we do as traders is deploy some form of risk management. I tend to favor the utilization of options for a lot of my hedging, but I know that you like to use stop losses. But the key, I would say, to just answer our listener's question is yes, if you are or if you feel you do have an edge with using stops, you should. The thing is that if you put your stop losses too tight, then of course you risk that you're going to get shaken out by just short-term noise and liquidity. But often some of the best stop losses are simply put at levels you know you're wrong and you shouldn't be in the trade. And at some point you got to pull the ripcord and exit a trade that isn't the one that you were looking for. And so a stop loss is a sort of a forced way to bring you back to cash. And I think it plays that role. What do you think?
Some wise words there. I'll give you just kind of as a little bit of as someone who trades from a shorter term perspective. I sympathize with the idea that you get shaken out of something where it kind of zips down there, and the next thing you know, it's right back up. And for me, one of the things that I did was I created a routine for some of my trading that actually allows me to make a stop loss that once it gets triggered, I then have an hour or whatever before it has to actually be there before I actually execute it. Meaning, if let's say I have a stop loss at $20, it ticks at $20, the countdown starts, and then after the hour or whatever I specify, if it's still below $20, my program automatically goes and sells it. One of the things is, so that avoids the kind of the spike down that quickly jumps up, but at the same time, that creates a lot more risk because now my stop loss at 20, what if it goes to 19? What if it goes to 18 from there? You can also do this. One of the things to think about is if you're trading it from a little bit of longer term perspective, you could do a stop on close. And I think that IB has some logic in there where you could start to do that sort of thing. So meaning that it's only if it closes at that level will you actually sell it. Just be aware that both of those things do introduce more risk because, as I say, both of them mean that you could be executed far away from your stop.
Right. Okay, so let's go to the next question, Lena.
Next question. Hey all, as I listened to Kevin cheating on Patrick on that other podcast with Patrick's mistress, tension in the Market Huddle studio fighting for the love of both of their lives, I heard you cite multiple economic surprise indices. As we look at things like gas demand that were historically correlated with COVID flares continue to gain ground back to historical norms, better than we were even in May and June, what do we make of the economic surprise indices? Are they just ahead of our skis in that expectations of economic growth actually looks like? Huge fan of the show, guys. Thanks again.
Great question. I did cheat on Patrick, but we do have an open relationship, so he's fine with it. An economic surprise index. It is correct that the economic surprise has been disappointing, meaning it's been going down, and therefore economic releases are underperforming where our expectations were. So one of the things that we just need to remember there is it's versus expectations. So if expectations get to the point where it's unrealistic and there's no way we're going to hit it, even if the economy is doing well, you could get a situation where the economic surprise is going downward. Now, having said that about gasoline, I do think it is interesting. We had a record driving season and more gasoline used than ever. I think that's a little bit of a function of the amount of traveling that North Americans did. I know here in Canada, very few people, even though I think we're allowed to go to Europe, most people aren't as adventuresome as Patrick, and many families that I knew were just staying and driving across Canada. In fact, it was when I went on my trip, the people said they've never seen so many, when I was out west, they've never seen so many kind of people from the east, from Ontario and Quebec and from the Maritimes out there. So I think that that's what you saw in terms of the gasoline surprising to the upside was the summer driving season. And then on the whole, on everything else, the economy has suffered because when we think back to, let's just say the spring, when we were thinking about what was going to be going on with the economy come this summer, everyone was ready for the vaxxed and waxed summer, all those kind of exciting things. We thought it was going to be like the 1920s. We were going to be drinking all sorts of fancy cocktails, and the virus was going to be long gone. And it turns out that Delta is not. So I think that that realization that the virus is not going to be a one and done affair once we get the vaccines was why economic growth performed so badly. And at the same time, that's why gasoline performed so well.
Okay. Sounds good to me. Lena, next.
Okay, last question of the week. When a company has shares trading on multiple exchanges, are the shares split up somehow? If one exchange has listed options and the other does not, but trading hours overlap, would dealers only use the options ticker to dynamic hedge, or might they use both? Can having a dual listing make a gamma squeeze more likely if the float is split up across exchanges?
Okay, so I can answer this because I made a living doing this in terms of when I was at the bank. I was one of the first to create an interlisted arbitrage machine that did this automatically. When you have shares that are listed on two exchanges, usually, and there are exceptions, but usually the exact same share trades on both exchanges. And you can set, when you're trading on exchanges, trades in a currency at a specific venue. So, for example, here in Canada, we traded Canadian dollars, we settle at CDS. And then in America, they traded US dollars and they settle at the DTC. So there'll be different places to settle, but for example, I could go buy American Barracuda. I'm showing how old I am. Let's pick something that's Shopify. I could buy Shopify in Canada, and that exact same share, I could then go and deliver it to the US. So there aren't actually two classes of shares. There's no dividing up a certain amount of the float to trade on one exchange versus the other exchange. It is all the same that we're trading back and forth. And in essence, all it is where you're going to deliver those shares. And with a broker that has the ability to settle at both exchanges, it doesn't really matter. And it's just kind of an accounting back office thing. In terms of whether that affects gamma squeezes, I don't think it actually changes anything. The reality is that most brokers, they use since the advent of computers, a sophisticated broker will use source Canadian liquidity just like the source US liquidity, meaning that if they have to buy shares and they see it in Canada and they can buy it and convert, they'll do that just as easily. So I don't think it really affects the gamma squeezes. And I don't think you should factor it into whether it's more likely to occur in those stocks.
All right.
Lena, this is the point where you tell us where they send.
Oh, I thought maybe Patrick had more things to say.
No, Patrick doesn't have anything to say.
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle. We're on Twitter every day. Lena's there. And Lena, we're getting up there with your number of followers.
Oh, I'm trying not to pay attention to it because I don't want it to get to my head.
Very disciplined of you. Please give Lena a shout. She gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate and review us on iTunes. You know why. Patrick, where can they find you?
You can find me at bigpicturetrading.com or on Twitter at Patrick Ceresna. Where can they find you, Kev?
They can check me out on Twitter at Kevin Muir, or they can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay, let's do the beers. Let's get them over with here. Well, you guys go first. You have the real beer.
All right. Well, you know what? This Super Bock, you know what? I'm going to go down the middle. Like, I don't want to rate it too high, but it's not a bad beer. So, like, maybe I want to go higher than 7.5. So let's give it a 7.7.
You're tough. You're like tough. You'll talk about how great it is and then give it a 7.7.
Yeah.
Lena, what do you think?
Actually, I what do you mean? I think that's a legitimate
good score.
Like,
I don't know.
I don't consider it.
There's beerflation out there, just like you know how there's like.
Look, you know what? I think
you know how like kids are getting better marks because of COVID. We're going to give
no. I'm sorry. We should bring the whole bar a little bit lower, Kev, because like you've rated beers all the way down to like I think 2s and 3s and shit like this.
Those are for sours.
That means
No,
like
it's the
a
Browns.
middle
I can't stand
of
the
the
Browns.
line beer on this other side of the bell curve is a 5. And the thing is that it like think of it just like rating in relationships how people are. Like you can't give everyone an 8 or a 9. Yeah, there's got to be 7s and 5s and 6s. I mean,
I don't know how.
fair.
Yeah.
I don't know how this the relationships came.
I
in.
didn't think you
but-
rate
I'm just
relationships.
No,
gonna
but I'm
leave
just saying you can't. No, but I think that if a 7.7 is a legitimate score,
Okay.
and you can't bust my balls for that.
Okay, I won't. No busting of the balls here. Lena, what do you rate it?
I'd give this a 7.9.
Okay, there we go.
Yeah.
Okay, and I'm drinking my Barn Raiser Country Ale. My buddy, as I said, my buddy Andy says I got a lot to go through here still. I love it. It's the only one. I can't. He did give me some browns, and I don't know what I'm doing with those. But this one I love. I don't know what I gave it last time. I'm going to give it a solid 8.4.
Oh, that's a really high score for
Okay.
you.
Yeah.
Yeah.
Okay, so let's. What's new and exciting?
Oh,
Patrick,
by
tell us
the
all about
way-
your place.
By the way, I just want to do a quick shout out to the listeners that if anybody is going to be in Vienna in the next 2 weeks and wants to do a little mini huddle piss up and wants to come out for a beer out in Vienna, make sure you reach out to me on Twitter and we'll find a night to go out for a beer. I'm going to be out there and it's going to be a great time.
Patrick,
reach
what
out.
the fuck's going on, buddy? So I thought you were in Lisbon. Now you're telling
I
us that
am.
you're going to be in Vienna. You're like the Patrick, the international man of mystery.
Yeah.
What's going on? Like you're going to? Austria?
But afterwards though, I do have to make it back for the moose hunt. So this adventure ends.
See, now there's a true Canadian for you. I'm doing all these sophisticated things. I'm going to go to the opera in Vienna or whatever it is you do there, and then I got to get back. I got to make the moose hunt, and that's important. I don't want to miss the moose hunt.
It's crossbow hunting this time, right?
That's right. That's
Yeah.
right.
Yeah.
On my trip, I saw some moose. I sent Patrick the video. That was my one conversation I had with Patrick during that month. I was like, look at what you missed. And that was it. That's all we talked about the whole month. I sent him moose pictures that we saw on the side of the road.
That was more than enough, Kevin.
But
for me.
Patrick, we actually have to talk about something because I think that you're going to be excited about this. Okay.
Okay. All right.
So let me just set the picture here. So obviously we drove across Canada. We did lots of things. For those who don't know, my wife drove her car and I drove the RV. She gets sick. She gets motion sickness, so she wanted to bring a car. She can't drive the RV. Anyways, long story of it. So I'm in the RV with some kids. Some kids are in the other one. One night we're on the way back. We're going to the grasslands in Saskatchewan, in southern Saskatchewan, and it's almost in Montana. It's basically at the border. Okay, and it's in the middle of nowhere. It's a long drive, shitty road on this, RV going back and forth and stuff like that. Driving along, my oldest daughter's beside me. We're sitting there, and all of a sudden she's like, "Deer!" And I look, and I swear to God, it's an antelope. And I'm like, Jesus Christ! Somebody has got a petting zoo out here, and their antelope has escaped. And I'm like, what the hell's going on? Stuff like that. And I'm like, oh God. And then we're going. So we proceed to see a lot of deer, but no more antelope. Then I'm there the next morning, get up, and I look around, and I'm at this national park, and they go through all the animals, and I shit you not, Canada has antelope.
What?
Yes. See, now you feel the same way as me. Let me get you the name of this stupid antelope.
Because it's stupid. It's
I think
not the smart antelope.
It's called a pronghorn.
Okay.
And they're in the southern part of Saskatchewan in Alberta. And so we went looking for them. They were fun. They're everywhere.
Oh, wow.
Yeah. It's pretty wild. It's pretty wild, but it's like, it was hilarious because I knew that it was like, that's no deer. That was like, I honestly, I said, it looked like an antelope. Yeah. So Patrick, you should go there and, bag yourself a pronghorn. I don't know if you're allowed to. Maybe they're endangered or something. And like, I'm telling you to go kill some, like, and let me just see here. But anyways, it's wild. I had no clue at all.
There you go.
Very interesting looking.
That's awesome. I'm gonna go look this up.
Yeah, I had. There it is. Like there he is, the pronghorn.
So,
okay.
So how was it? I love that meme you sent out with you after a month on the road with the family.
Yeah.
Was it everything? Most people like, okay, the idea of having an entire COVID lockdown where your entire family and your children are all stuck in the same house that you for that extended period of time. Yeah. Well, take a house and then shrink it into a mini condo on wheels and then jam them for a month going across country. Was there anyone murdered? Was anyone murdered?
No. And I'm still married, which is a good thing. When you said that, you remember when the COVID first happened and there was that video going around and there was this fellow and they were interviewing him and they said to him, do you choose spend a month with your family in lockdown or B, and he doesn't even let the whatever it was. He's just like beat. Yeah, that's what you make it sound like. I did have one of my good buddies, one of my dearest friends, after I come back, he said, come on, tell me what it's really like. And he said, the only people, he said, I've done it a few times, but I usually it was in my days when I was single and we did it on music festivals and there was a lot of drugs involved. But he said, the only people I know that have done it like as adults, he said, were this two couples that went and they went with all their families. They both rented RVs and they no longer speak to one another. and I was like, yeah, that's about it. So we made it, how far before we started hitting the hotels? It was pretty quick. Once we started, once my wife got it close to we're gonna check in here. So it ended up being driving the RV. Yes, there were times we slept in it. I don't want to make it sound like we never slept in it because we did sleep in lots of places.
I think it's easier if your kids were much younger, like if they were smaller kids.
For sure. You're absolutely right.
Like
they're big and yeah. People. It was listen, it was fun. Like, it was nice. Like when we went to this grassland place, we got there late. Like the last thing I'd want to do is pitch a tent and do, figure that out. This thing, you just go there and you park it and then you move the things out and you're boom, Bob's your uncle and you're in bed. So from that perspective, it was terrific. I'm so glad I rented. Some people I know have bought and they said, oh, we're going to do this as a family every year and stuff. And no, renting is the right call. The other thing is we brought our big dog, so we couldn't fly back. But I think that if I could do it again, I would suggest you just go one way and fly back. But it was great. Like, it was terrific. Like, and I do want to do a big shout out. There was at least 2 of our listeners that told me that I have to go and spend extra time in Jasper. At least 2. And they reached out to me, and I'm sorry that I can't remember who they were. Or maybe they were readers of my letter, whatever they were. But the 2 that told me, it made an impression. I definitely made extra time for Jasper, and I was so happy about it. I had been to the mountains many times, going skiing and things like that. I've never been in the summer, but Jasper is truly outstanding. Some of the most beautiful scenery I've ever seen. It's something that everybody should do, and I think it's one of those things that's a little off the beaten path in terms of you go to Banff and you're going across. It's a little out of your way, but it's well worth it.
That's awesome.
Yeah, so it's a lot of fun.
Yeah.
And actually, one last story, which I got to tell you because I thought this was pretty funny. So we spent a week in a place called Kicking Horse. Kicking Horse is a ski resort. And my good buddy Andy that gave us the beers, he gave me his condo there. So not only were we going to hotels, we were also staying in a condo for a week. So he was very nice. He gave me a condo at Kicking Horse. And at Kicking Horse, what had happened was there was a grizzly bear that had been on the side of the road with her 2 cubs, and some just horrible human being pulled over and shot it. Yeah, terrible, right? And so they were really little, the bears, the cubs, and they went up a tree. And so the conservation officers come and they're trying to get them out of the tree, and it's a shit show because they can't come down and it's hard. Eventually, you get the 2 bears out of the tree, and they're like, "What are we going to do with these bears?" and stuff like that. And Kicking Horse was just getting developed as a ski hill, and they said, "We're going to make something for them." So what they did is at the bottom, like kind of as you're going up the gondola, they've carved out 20 acres, and they've made a fence around it. In the winter, obviously, the bears are, well, it's a bear, but I'll tell you that in a second. They're hibernating, so there's not an issue with the skiers. And then the summer, you can go and it's something to go see the bear, right? So originally, there's 2. Unfortunately, one of them dies during hibernation at 1 or 2 years old. I can't remember how old he was. So there's only one bear there. Okay. His name is Boo, because I think it was the Caribou Mountains or something. So they call one Carrie and the other one Boo. So Boo the bear is there. He's this big bear, and so he's a good guy. They get to know him. He's a lot of fun. They feed him. They try to feed him only 50% of what he needs to get, and he has to figure out the rest of it on his own because they don't want him just to become caged or whatever, like a caged bear. They want him to keep doing it. He actually, at one point, a moose gets into his pen somehow, and he kills the moose and eats the moose. He's like eating like high on the hog, but he's your kind of bear, Patrick. He's just like, I'm going to kill this moose. I'm going to eat the moose. Funniest story though is, so he's been there, I don't know, half a dozen to a dozen years. He's never shown signs of getting out. There's been no issues at all with that. And all of a sudden, this lady grizzly starts coming by. And they're seeing this lady grizzly coming by. They're a little worried about it, but they're like, not, the wardens or whatever. They're like, okay. They get up in the morning one morning. Boo is gone. Boo has said, I've had enough of this. I know I get my food and everything.
Something better out there.
There's this lady grizzly that's calling my name. So for 30 days, they search for him. They can't find him. Nothing. 30 days he's gone. Okay. Finally, after a month, he comes back. Now, he's a little beat up because he's gotten in a fight with another grizzly and stuff. Maybe another one that was after the lady grizzly, but who knows? And he comes back. He's just like, okay. And so they go, well, we better figure this out. We better figure out a better way to keep him in. So you think that they've learned their lessons, everything's good, and the Boo's just going to live the rest of his life, in the cage. Nope. Kind of 5 years later, another lady grizzly comes by, and Boo figures out a new way out.
Wow, Boo's got game.
And he disappears for another month.
Wow.
And then he comes back. Hilarious. Can you just imagine him like sitting there like, okay, guys, let me in. I'm ready to come back. Yeah. It is so funny. He has no desire to leave except for when the lady bears come by. Anyways, I love Boo. He's a good guy. Yeah. He's a good guy. And
Boo's my kind of guy.
Yeah, he really is. And what's funny is that we went and saw him, and so you see him, and we were lucky. The first time we saw him, he'd come down to get his food or whatever, and they put it up in a tree or something to make him do something, so he has to work for it. And then the next day, I was there during the heat wave, and some other people, I saw them going to see Boo, and I looked when my son and I are going up the gondola to go mountain biking, and Boo's just sitting in his little pond in the middle of his 20 acres. And we're going back and forth every kind of couple hours, we're going up and down this thing, and I keep thinking he's going to be moved. He sat there, this lazy bugger. He sat there the entire day in the pond. I swear to God, he just sat there the entire day.
Who knows what's up?
What a good life.
He's just like, screw it, it's too hot, dude. Like, he's just like, he just sat there the whole day, and I'm like, he's got to have moved by now. And nope, he's just sitting there. Anyways, Boo's a character. If you're ever anywhere near Golden, BC, go to Kicking Horse and check out Boo. It's quite a funny story.
That's awesome.
Yeah.
That's awesome.
Anyways, how was Portugal? You guys both went. You got to tell us what it's like. Had you been before?
It was my first time.
Yeah, no, actually, it's my first time too. But I'm loving it out here. It was great. It was great. I'm still here. I'm still going out after this. That was great. It's fantastic. The coast, the mountains, the ocean.
The weather was perfect the whole time I was there. It was just perfect.
Oh yeah. And I found a way to expense it. Had a bunch of Big Picture Trading members come out here for a mastermind session
Patrick,
and traded with them for a week.
Supposed to say that out loud. God almighty. CCRA guys, like, okay, please check out this guy. No, it was a legitimate experience. He was working hard.
It was a
workation.
hard week.
It was a workation. That's right. That's what Lynn's doing. She's workationing in Egypt. You're workationing in. I have a friend who is telling me that he's looking at going to Portugal for a month, and he put it into his Airbnb, and he was trying to find something. He's like, this is bullshit. There's nothing to rent here. And then he realized that he had set his minimum, like he had put his minimum too high.
Oh my god!
Because usually you put a minimum to weed off all the crappy ones. And he's like, holy shit! And he says he thinks it's the best value in Europe.
It's you know what? Like, listen, I've been to a number of places in Europe, and this is very reasonably priced. Great seafood, great people. Everyone's so friendly. You can get by with English so easily.
They all probably think that we're assholes, but yes.
Yeah, but they probably do, but they don't. They at least smile at you when they're thinking it.
That's all you ask. That's all you ask. You can think I'm an asshole. Just be nice to my face.
And you know what? Like, I have never drank so much port in my life. I actually went up to Porto for a weekend and did a port tasting thing at all the different not breweries. My God, this is me talking about the thing. All the wineries or whatever. But and it was just great. I'm like now hooked. I love port.
That's just what you need is another liquor that you didn't know. Patrick's like, guess what? I found another liquor that I like. Shock.
Surprise.
I'm going to get you like a Ronaldo Sucks shirt and make you wear it around.
You can do that.
Are you going to go? At least you should go to a soccer match or football game.
Oh, no, I'm done. I'm leaving in a day or two. And didn't make time
Did you go see the bullfighting thing?
No, I didn't.
You shouldn't do that.
Going there.
I thought that was Spain. They do it there too?
No, they don't. This is over here. They don't kill the bulls. Yeah. That's Spain. You have to go for that. Like here, okay. They put on a show with the bulls somehow.
Oh, that's better. That's good.
But
you should have done that. You should have supported the one that they don't kill.
I have supported all the local bars.
That's good.
Like day 3 in, everybody at the grocery store and the liquor store knew Patrick. So. We were like, we need to get you a loyalty card or something.
Oh my God. You're like Norm at Cheers. Like when he walked in and everyone, Norm, and started pouring a beer. That was like, Patrick, beer. That's awesome. You don't speak a word of Portuguese, right?
No.
No.
I was gonna pretend, but no. Let's say I have zero.
And upset more people.
Well, that's awesome. That's awesome. And how long were you there, Lena?
Oh, I was there for 2 weeks. Yeah.
Oh, okay.
2 weeks. So it was.
And she snuck a little trip to Paris.
Oh yeah, yes, I did go to Paris since I was, close enough.
Have you been before?
No, Paris was. Well, I had been there when I was like a little kid.
Give me a very close enough. It's like still a 2.5 hour flight. It's like going from fucking Toronto to like Florida.
The ocean and
Oh.
Most people don't realize how far Portugal is from
it's very
the central part of Europe, right?
Yeah.
Like it's. But anyway, it's beautiful.
Actually, now that you say that, though, I want to talk about one thing. I didn't realize it. This is Terry Fox Day.
Today is the Terry Fox Day?
It's this weekend, I believe. And for those who don't know, Terry Fox was a Canadian, a young kid who decided he was going to go and in the 80s.
20-something. I'm not kid.
Yeah, he's a kid. He's a kid. The 20-year-olds. Their brains aren't fully developed yet at 21. They're still kids.
Yeah.
And he had lost his leg to cancer, and then what he was going to do is he was going to run across Canada. And so he dipped his leg in Newfoundland and started from that side. And he made it all the way to somewhere outside Thunder Bay. And I, as a true good Canadian, I pulled over to see the memorial when I was actually driving across Canada. But the reason I bring this up is that every time there's a great map that shows you how far he ran. Now, although he only ran from, he didn't even make it out of Ontario, but he went from the Maritimes all the way to Ontario. That distance is the same as going, listen to this, Patrick, as from going from Seattle to Miami.
Holy.
I was shocked at when this fellow has this map and he shows like where it is. Terry Fox run world map, and you can see it, and it just shows you how big Canada is.
Yeah.
When you see that, kind of comparing the runs on like versus the rest of the world. Like I would have never thought that it was that big. Yeah. But it obviously is. Let me see if I can get this for you. Have you do you remember that, Patrick, or were you too young?
Oh no, actually I remember at the time I was in Bradford, Ontario, and he was running down Yonge Street. And basically, my mother brought us out to see him do the run.
Oh, by the way.
I
oh,
got
really?
To see him run by.
By the way,
I didn't know that.
I was just a youngin', but I saw him actually run right in front of me.
That's awesome. I had no idea. So he never made it to Winnipeg, so I never got to see him. Okay, so here it is. I got the map. So
by the way, Terry Fox Day is first Monday of August. It's Terry Fox Run that's happening this weekend.
Okay, that's right. Okay, yeah. I'm sorry. So interestingly, let me just pull this up. It looks like if you went from Portugal and you were running it there, you would make it all the way to Russia.
Whoa! Wow!
What?
Yep.
What?
Wow! That's crazy.
How many kilometers?
I don't know. Let me just look here. So let's see how much he made. Okay.
That's a crazy freaking distance.
He ran a marathon every day, and he went for,
over 5,000 kilometers.
Yeah.
He ran.
What?
He ran close to
That's
42
nuts.
kilometers. That's about 26 miles a day.
Yeah.
And so he ran
with one leg, dude. With one leg.
So he ran about just shy of 5,400 kilometers.
There you go.
Oh, yeah. Okay, yeah. That's quite the distance.
just shy of 3,400 miles.
And the thing was, he wasn't even like halfway in Canada, or maybe he was. I don't know. It was around halfway.
That's nuts.
Anyways, I must say I did tear up a little when I was there.
Yeah.
When I was at the memorial and stuff. I don't know why. I was
Canadian boy.
Good Canadian boy. He's probably one of the one of the people that we should actually really celebrate a little bit more.
Yeah, totally.
Because we're too busy celebrating hockey players or whatever, and we should probably be working harder on celebrating Terry Fox. Anyway, so that's my little tribute to Terry Fox. But it's just when you said Portugal. So Patrick, why don't you do that? Why don't you, in tribute of Terry Fox, go from Lisbon to St. Petersburg or whatever it is. Well, we won't miss you, bud. It's okay. Or you know what? Actually, in this day and age, you could just call in from the side of the road.
Yeah, you can FaceTime us.
Yeah.
Great idea, Kevin.
I hear December.
You can drink all the way through if you'd like.
That's right. I hear December in St. Petersburg is really nice.
All right.
Okay. Well,
all right. I'm done.
We'll save all the rest of the stories for another day. Okay, folks. We'll see you next week. Thanks for tuning in.
That's great. Yeah. Well, I'm so glad we're back in huddling, man. That's that this summer gap was a rather large distance of time. But anyway, we're back.
I love you too, man. I love you too, man.
I love you guys.
It's like that TV show.
He's like
slapping the bass. Slapping the bass.
He's like 5 hours ahead, so he's probably lost.
Yeah, that's right. He's probably already drinking. Okay.
All right.
Okay. See you guys next week.
Have a good weekend.
Cheers.
Bye-bye.